Okay, very good evening to everyone. I am producing this video from my home on a Sunday evening, all right, but it'll probably launch on a Tuesday afternoon. Okay, um, this is the 99th episode on this YouTube channel, and I've not decided whether I want to carry on beyond episode 100. Okay, so right now what I'm doing is that I'm slowing the frequency of my material, but the material hopefully would be getting better and better because I have a certain idea about what kind of videos would be able to generate a view of at least 1,000 for every video that I do. And I think that's probably better to create a longer 20 to 30-minute video that can hit 1,200 viewers than to build many of these 8 to 10-minute videos that can only attract 2 to 300 views. And we're going to do another very general kind of discussion today. And today we're going to give a rookie a very broad, high-level introduction to equities in the Singapore stock market. Okay, and this is going to be a discussion that is very broad in nature, and we will focus on the STI index as well as the upcoming Singapore Next 50 index. All right. Then we will drill into 4 broad areas that a rookie can look at. We'll look into a little bit on banks, real estate investment trusts, business trusts, and Singapore depository receipts. And what I've done is I've taken some of my course materials that was complete in December. So the materials are dated around October and November. Okay, and you know, in my class is a little bit different. Every time I conduct a new class, the materials change very drastically from batch to batch. So I have a lot of materials that I can offer for free for the people in my channel, and for the folks who want something that is updated, that covers all the latest information, then by all means do consider my class. All right. Otherwise, the presentation today, we will not make any concrete investment recommendations. You know, I can't do that. Okay. So nothing is a buy or sell recommendation. But for inspiration, you can look at the other videos on this channel if you're interested in a particular category. Okay. So let's go ahead and talk a little bit about the Straits Times Index. If you want to understand Singapore and Singapore investing, you need to understand 30 of the largest blue chip counters in Singapore. Okay, this is often a barometer and a leading indicator of the health of the Singapore economy. And the important takeaway is that our Straits Times Index is capitalization weighted, right? So the stock counters with a larger market capitalization will have a larger proportion of money invested in it, right? And so you will find that for STI, over 40% of your assets are distributed between DBS UOB and OCBC. And so it is very much a financial kind of index. Okay. And one way of buying the Straits Times Index is to buy the STI ETF. And the ticker symbol is ES3. ES3. Okay. All right. So let's do a little bit of data exploration, okay, to strengthen a retail investor's instincts so that over time, after going through the video, you know, hopefully you become sharper as an investor, you develop equity, ACUITY, equity, when you're looking at financial news, okay? And what we are going to do is we'll talk about the 3 important market anomalies exhibited by the STI. All right, the first is the January effect. I know we're now January 2026 and you're experiencing it right now. Stocks that underperform in the last quarter from October to December will begin to outperform in January. All right, so Trump has just launched an invasion of Venezuela. I do not know whether the Capricorn effect or the bull market is going to take place on Monday tomorrow. Okay, I'm very excited, and maybe future videos I'll talk about what has happened. Okay, but generally speaking, there is a Capricorn effect. If you underperform in Q4, you will outperform in January. Okay. Next is the Friday effect, where somehow performance in the Singapore stock market is slightly better on a Friday. All right, but you might not be able to exploit this. The effect is very small. Okay, but the important effect that I think a lot of ethnic Chinese communities experience is the August effect. And that is when the STI experiences their worst month, typically in August, right? But we know that that the reason why it is the case is because of the Hungry Ghost month, and it's got a consistent kind of negative effect in the stock market. So those people who are thinking of accumulating stocks, you could consider, bunching up your income into a lump sum and deploying it during the Hungry Ghost month. Okay, and there is some evidence that you can actually take advantage of this. Okay, so here's evidence on the Friday effect. If we create some sort of a pivot table using Python on 17 years of data up to 2020, which I've done in the past, you find that Fridays do happen to be slightly better than other days, with Wednesdays being a close second. All right, and you find that this similar effect does not occur for things like the Dow Jones Industrial Average. All right, so really very small, very hard to exploit, but at least we understand what it is. Right. Secondly, if we break down the returns for the same 17 years uh, for the STI, you also find that August is definitely the worst month of the year, right? So when people talk about things like sell in May and go away, yes, May is a negative month, but it doesn't come close to how bad things are in August. So you could actually prepare some sums of money and then just start deploying it during the Hungry Ghost month. Okay, and that'll be very fun because you notice that September, October, all the way until January, these are positive months. Okay, these are positive months, and you'll be able to earn a little bit lah, all right, by taking advantage of this anomaly. Okay. Okay, so that's a beginner primer for the STI, 30 of the largest stocks in Singapore, is dominated by banks, right? So now let's talk about the IH Singapore Next 50 Index. It is the following 50 counters, right? The following 50 largest stocks after the STI, okay? And this is something which the government is trying to promote because with this index, money from family offices can then flow into our mid-cap counters, not exactly the largest counters in Singapore, but the ones who are on its way up, right? And SGX produced two indices. There is the market capitalization indices, and there is one that is weighted by liquidity. I'm not sure how valuable that is, but for me, I will just confine my discussion on the market capitalization indices. And I just like to remind everybody that the IH Singapore Next 50 Index is dominated by real estate investment trusts. Okay, and about 50% of the market capitalization, or sorry, 42%, if you allocate your money into this next 50, most of the amount of money will be real estate investment trusts. Okay, all right. So it's a very new index, so I'm not going to crunch a lot of numbers on it. And the fact that it is now an index would mean that more money would be flowing into these counters. Okay, but nevertheless, I have performed some back tests to cover the 1st of January 2015 to 1st of October 2025 using Yahoo Finance data. And you can compare the two performances here. So back in October, when I did this, we find that the STI returns and the SG Next 50 returns, obviously the STI is leading slightly for 10 years of data. Okay, but I could imagine the SG Next 50 catching up over time. Okay, but you don't have to worry so much about the difference because the correlation between the STI and the SG Next 50 is very, very high, right? So generally speaking, STI and the SG Next 50 will go up and down together, all right? And so there's really no need to really treat them as a separate kind of index, right? So when I conduct investment classes, I would perform a back test, and I do factor investing for all 80 of the stocks, right? For all 80 of the stocks. So yeah, so just have you know that we are also trying to exploit this uh, injection of a lot of capital, right, coming into the Singapore stock market over the next 1 year or so, right? There is $5 billion coming in from the MAS Equity Development Plan, I think Equity Markets Development Plan, EQDP, and I think not a very small amount has been deployed so far. So we could be seeing a lot more tailwinds for these two indices, right, over the next 1 year or so. Okay, So once we have this broad idea of the Singapore stock market, right, let's go into 4 useful areas that a rookie investor can look at. And I've divided into very simple 4 areas: banks, real estate investment trusts, business trusts, and Singapore depository receipts. Okay. Now, different investors have different ways of categorizing important points in the various markets. Like if you are a very old investor, you know that in the past, the Jardine related companies like Jardine Matheson Holdings, and Jardine CNC, these companies, right, including Dairy Farm, Mandarin Hotel, they can also be a separate category on their own. And then for some people, they would consider real estate developers, like CDL, um, Fraser's Property, to be another separate kind of cluster. Okay, so for me, because the people who follow me tend to be very dividends oriented, I have decided to talk a little bit deeper about these 4 areas to introduce the Singapore markets to you. Okay, so let's begin with banks. Okay, and banks are the largest companies in the STI. All right, and there's some very useful terminology when you're looking at investing in banks, right? You want to look at net interest income, right, which is the difference between the interest income and interest paid out by financial institutions. You want rising net interest margins to know that banks are doing well, right? So right now, as interest rates are being lowered, net interest margin is declining. So there's a probability that banks might underperform over the next 1 to 2 years, right? But that's not the only thing that banks earn money from. They also earn money from wealth management fees. So banks that manage to provide wealth management services to their clients, they will tend to do very much better, all right? And you would also be useful to understand what is Tier 1 capital ratio, right? The ratio of a bank's core equity capital to its total risk-weighted assets. Okay, and this is something that MAS needs to maintain above 6.5%. And you find that our Tier 1 capital ratio for our big banks is above 10%. So this is very safe. That's a number you want to follow when you read the news. And you also want to follow this thing called CASA funding, right? It's your current account, savings account, right? And these are the lowest cost funding options. If CASA funding becomes more expensive, it's also bad for banks because that would lower the net interest margin. Okay, so generally speaking, these are the things that you need to understand when you're looking at our local banks, all right, to be able to invest in them better. Okay, and in November 2025, generally analysts are neutral when it comes to banks. Everybody is aware that net interest margins are under pressure. Okay, wealth management fees have been decent. Okay, and somehow the analysts believe that it's slightly better for DBS than the rest. Okay, you normally buy banks if you want attractive dividends, right? And now it's between 4.8%, right? Higher than 4.8%. Okay, but the fact of the matter is, moving forward, when this video was built, banks is no longer a sure bet. Okay, as interest rates are dropping, NIM will drop. Okay, so the key question is, if people take on more loans, condominiums get sold, right? All this is going to be beneficial for people who invest in local banks, right? Okay, so I've also tracked the interest rates, which have been falling from January 2006 to 2009, right, and rising from 2015 to 2019. And you find that banks tend to underperform when interest rates go down, and banks outperform when interest rates go up. Okay, so generally speaking, if you are trying to benchmark banks, right, against the rest of the STI, a very simple way of understanding how banks work, right, is to simply follow interest rates. Okay, so interest rates go up, banks do well. Interest rates go down, banks do badly. Okay, so very, very easy way for a beginning investor to get a basic idea of how to get started with this. All right. Okay, so we're done with our discussion with banks. So let's move into the opposite of banks, which is a real estate investment trust. And these are instruments that also give you 5 to 6% dividends. Okay, and this is a tax advantage instrument. Imagine drawing money from investors, getting money in the form of a loan to invest in real estate. And then this real estate assets, they generate rent for you. And as you collect the rent, you're able to enjoy your investments. And if you're lucky, as the buildings gain in value, the buildings can be cycled somewhere else. That means you sell the buildings and then you buy new buildings that give you a higher yield. All right. So real estate investment trust is an investment that allows you to be like a landlord. All right. So very, very useful instrument and a very good complement to banks in Singapore. And one very good example of an S-REIT is the Capital Integrated Commercial Trust, CICT. It is the largest REIT, in fact, probably the largest in Southeast Asia at the moment. just beaten Link REIT from Hong Kong in size. Okay, and the iconic malls include Raffles City Plaza Singapore and Funan Center, and its offices include Capital Tower and Asia Square Tower. All right, so the good thing about a REIT like Capital Integrated Commercial Trust is that you can see what you're buying, right? When you buy the REIT, you receive a dividend, right? I think once every 2 months or once every twice a year or 4 times a year. Okay, and at the same time, you can also review your buildings. Like you want to see how well Funan Center is doing, head over to City Hall MRT and have a look at your investments and see how well they're doing. Okay, so SGX has become a haven for REITs. Okay, and 23 of these REITs now fall into the SGX Next 50. Okay, and they're very attractive for people looking for stable dividend yields of above 5%. Right. The question is, obviously, what kind of strategy you want to use to get real estate investment trust. Okay, and what role do REITs play in your portfolio? Okay, a low volatility way of getting a 5% payout every year. Okay, and it is the opposite to banks, right? It tends to do better when interest rates are going down. It does very much worse when interest rates are going up. Okay, so you know that whenever you buy a bank, you might want to balance it by owning a REIT so that they form a counterweight to each other, allowing you to sort of partially immunize your portfolio from changes in interest rates. Okay, all right, and you can find all that in the SGX website. Okay, all right, now just remember that when we try to invest in REITs locally in Singapore, it helps to remember the infamous March 2020, the 2 weeks on March 2020, when in the middle of the COVID pandemic, REITs had a very drastic crash. Now, it's important to remember this because it's good to understand what led to that crash. Over the years, because REITs have done very well, relationship managers started to get their clients to borrow money from brokers to increase the dividends that they receive. Okay, and this strategy has been successful for many, many years. And some of the more sophisticated relationship managers might even say things like, why don't you leverage using Japanese yen? So you loan in Japanese yen, you pay a lower interest rates, and then you get the 5-6% from Singapore REITs, and then you pay the interest on the Japanese rates. And then you're fine and good. Okay, that is a very dangerous kind of play, but it's quite bread and butter, right? It's called the yen carry trade. So what happened is that when there was a pandemic, there was some concern as to the viability of these REIT portfolios. And I think the bankers started to ask their clients to unravel these leverage holdings. And as they unravel and they sold these REITs, it triggered margin calls for many other investors who have also applied the same strategy. And over time, this led to a snowball effect. And there's a death spiral. Okay, and it dropped by 20 to 30%, I think, over a period of 3 to 4 days, I recall. And it was really one of the worst things that happened to the REIT investors' life. Okay, and I too had to liquidate some of my REITs in order to make sure that I do not end up in a margin call. Okay, so good to remember this as a history lesson so that you know that, there is certainly a lot of stability, but never forget that there are moments when that stability can be lost at the drop of a hat. Okay? Okay, so generally speaking, what REITs are, all right, they reward an investor for patience. Okay, 6% is a little bit too high this time. There are REITs that give you 6%, you can find them, but generally speaking, it's probably better to target 5% right now. Okay, it's very forgiving, okay, except during the pandemic. And after the pandemic, it took time for the REITs to recover. In fact, it didn't even recover last year, and it was a good year for the Singapore stock market. In my portfolio, we have more REITs than most other retail portfolios. And so we underperformed the STI slightly, all right, slightly by a few percentage points. Okay, it was still a very good year. I made about 20 something percent, 22%. So yeah, so I think there is some up, that there is still some way to go for real estate investment trust. And in November 2025, UOB Kay Hian was overweight on REITs. And I think there is a little bit of excitement over the merger of Mapletree and Capital Land. If it ever happens in 2026, we could be talking about super REITs, those with large scale bargaining power. Okay, and and more of these REITs will get bigger and bigger, and they will enter the main index. All right, so that's something to look forward to, hopefully this year. All right. Okay. So REITs have been ace performers, okay, but recently returns have not been particularly good. The recovery has taken place in 2025. Some way to go in 2026. Right? And so that summarizes real estate investment trust as another cornerstone of investing in the Singapore stock market. Right? And there are some older investors who only need to know both. Right? You have REITs, you have banks, they balance each other out based on interest rates. Okay, and you buy both and you collect 5% and you're good. All right, and you're happy and you're good. Okay, now, the third area that I think a good rookie investor needs to look at is business trust. Okay, so this is slightly different from a REIT. Okay, they are investments that give you a very high dividend yield, but you might need to face capital losses over time. It might need to raise capital. Okay, because imagine it is like a drawing oil from an oil well, right? As you draw oil from an oil well, right, you're getting some amount of money, all right, but the resource that you're drawing from gets smaller and smaller. Okay, so there are very good ways of boosting the dividends in a portfolio, but you need to watch these investments a little bit more carefully because the risk can be relatively high, right? Capital Infrastructure Trust, I think at the moment yields more than 8%, and Asia Pay Television Trust close to a double-digit yielder. Okay, what's the difference between a business trust and a REIT? Okay, so when it comes to a real estate investment trust, the trustee and manager are different entities. The manager can be removed with 50% of the votes. 1/3 of the board must be independent. There's a maximum gearing of 50%, and you must pay out 90% cash flow as dividends, right? So real estate investment trusts have done very well, okay, because of these rules. Now, business trust is a little bit different. The trustee also manages the property, all right? There's certain amount of entrenchment. So if you want to remove a manager from a business trust, you need 75% of the votes, which is very hard to achieve. So the majority of the board must be independent. There's no maximum gearing and there's no payout condition. So business trusts actually give a lot more flexibility to the party that is sort of managing it. And so over time, it hasn't been as popular as a real estate investment trust. Okay, and do note that for hotels, the hospitality REITs, they are both a business trust and a REIT. Okay, it is called a stapled security. All right, they're hybrid instruments. Okay, all right, now we're finally moving into our fourth area that you might also want to look at, which is very exciting. Entering into 2026, Singapore depository receipts. Okay, so these are financial instruments that allow a Singapore investor to gain exposure to a foreign stock. Okay, and the good thing is that they're all traded in SGX. So it means that when you buy Singapore depository receipts, they will be parked in your central depository, and your dividends will automatically arrive in your bank account, right? Converted into SGD, it will arrive in your bank account. So really, not much drama, okay? But what's exciting for me is that many of these stocks, because they're in Thailand or Indonesia, right? They have a very low correlation to our local REITs and banks. So you can basically find something that gives you 5 to 6% dividends, but they don't move the same way. So overall, I think our aim is to build an asset pool that gives you a 5 to 6% payout that doesn't change a lot, right? It will rise steadily, okay, but otherwise there wouldn't be sudden drops in its value. And so Singapore depository receipts actually allow us to do this, okay, and this is just a slide to explain how your dividends arrive. So the SDR issuer will convert the distribution proceeds into Singapore dollars, and then they will deduct any corporate action fees, expenses, and taxes. And then you will make a distribution through the CDP, and you will receive your money safe and sound in your bank account, right? Even when you're lying in a coma, you'll be able to receive your dividends. Okay, so it is something which I think the older investors would like to have, right? To find information on the Singapore depository receipts, you need to go to that menu bar on the SGX website, and you need to click the right arrow and scroll all the way to the right at the end, where you can get access to information on these depository receipts. And you'll be able to find all the big names from Hong Kong: Tencent, BYD, HSBC, Alibaba, and Bank of China. All right, so these are companies that they are blue chips in other countries that you can also add into your portfolio. Okay, now what I've done is I have ranked all the SDRs, and I show that there is a significant number of these SDRs that can produce a better cash flow than the STI ETF. And at the top is your current pork fund foods. All right, the dividend yield is relatively high, but double check. This is from Yahoo Finance. Information might not be too accurate. Okay, in second place is PTTEP, which is an oil company from Thailand, right? And the good thing is that the Thai markets are not very highly correlated with Singapore. There's also some political turmoil there, so it might be a good time for us to pick up some Thai counters, to diversify our holdings. All right. Okay, so this we're almost done with our introduction. All right, so I've done two things. I've introduced the indices to you. Then I've talked about 4 areas that you can look at. Right, what does it mean in practice for the rookie investor? All right, the final outcome of looking at all these areas is to build this thing known as a starter portfolio, right? And I obviously teach how to do this to my students with the specifics. And what we want to do is we want to be able to build a stable portfolio that can give you a dividend with just three counters. All right, great way to start a brokerage account. Okay, and then we can scale it into something more complicated later on with 15 to 20 counters. All right, and I'm just showing you in a very broad helicopter view of how this starter portfolio looks like. All right, one bank, one REIT, one business trust, one Singapore depository receipt. Nice set of 4. It's like when you buy Cui Kueh, sometimes they have this taster where you've got some Cui Kueh, some Chi Chong Fan, some radish cake and all that, right? So we build something very simple like a starter portfolio and become comfortable with income generation. Then we start to build our satellite picks, which is your small, mid, and large cap stocks from the Singapore stock market, as well as the foreign stocks that might complement whatever we already have from the Singapore depository receipts. Okay, and this is the topic of what I do, what I specialize in, and what I teach in my programs. Okay, and that's all I have for you today. If you like this content, you want to learn a little bit more about how we produce the starter portfolio, and you're interested in maybe upgrading yourself and learning a little bit about investing in the local stock market, then Google ERM intro, take the first link, come for my next preview, and I'll talk a little bit more with you. I'll be doing it live, of course, and I hope to see you soon. All right, and that's all I have for the 99 video. We will go for video 100 hopefully in a week's time. Thank you very much.